Hello sector watchers, welcome to the show. This is the 136th episode of Sector Spotlight on Tuesday the 19th of July, and I'm recording it on Monday the 18th. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands, where we are now having, well, a real summer I should say. We're approaching 100 degrees and apparently tomorrow it'll be 100 degrees. A full 100 degrees, by the way, that's Fahrenheit. In terms of Celsius, that's 38, 39, 40 degrees, which is really, really hot. What does it mean for Sector Spotlight? Well, the temperatures have nothing to do with it. Although temperatures on the market may be heating up now, I don't know. For today, I want to go over rotations for asset classes. I want to have a look at current sector rotations. And I want to highlight, I want to take an extra look at the growth value rotation. We haven't looked at that for a while and I think there's an interesting move going on. And if time permits, I want to highlight an article that I published today on seasonality versus the sector rotation model. I got a question, and usually if you get a question, it's more people that are struggling with something or confused with something, but they don't dare to ask or don't want to go through the effort of mentioning it. And apparently there was some confusion about the difference, or a question about the difference between the sector rotation model and the seasonality that I sometimes use here in the show. So I've actually written an article on that. Today it's published today on StockCharts.com on the RRG blog. And if we still have a little bit of time at the end of the show, I want to highlight it here for you as well. For now, let's get started with Sector Spotlight. Asset classes, what happened last week and over the last few weeks? We've got the RRG on the right hand side, the daily is on the right hand side and the weekly is on the left hand side. If we quickly go over the daily rotations, then you see that that is quite distorted by the tails for both commodity ETFs that we're tracking, DJP and GSG, and a similar situation is on the graph for the weekly RRG, where you see that DJP and GSG are also far away from the benchmark, from the center of the chart. So let's deal with those first and let's get that out of the way. What you can see is that the strength for both commodity asset classes is still very much present. GSG and DJP have the highest readings on the JDKR's ratio scale still of all asset classes, but they are rotating through the weakening quadrant after a very strong rally and rotation from improving all the way through leading for a long period of time and now coming down. And what we see on the daily is that quite logical, you see those tails inside the lagging quadrant because they are the more focused, more granular rotation of what's going here on those weekly tails. And you see that they have already started to pick up some relative momentum. Not much yet, but it's there and we got to monitor that, because I think that once you will see GSG and DJP on the daily RRG start moving in a positive RRG heading, so a heading between 0 and 90 degrees, and even better, move into the improving quadrant, that will very, very likely have a positive effect on the direction of those weekly tails and potentially turn them around while still inside the weakening quadrant. So I'm still watching those rotations for commodities as temporary in nature. The long-term turnaround is still intact, and what we are seeing now is a temporary setback as displayed on the weekly RRG, and the daily tails are on the way of picking up relative momentum and hopefully moving into improving, and then once they start pulling those weekly tails back up, we could possibly see a new leg upward in those commodity ETFs and the commodity as an asset class. I'm going to tick off those tails here, so GSG and DJP on the weekly fitted. Now we can see what's going on with the other asset classes. I'm going to do the same here. DJP and GSG, tick them off, and now we can see what's going on. This is now magnifying the rotations as we have seen them over the last few weeks. So this is last week, this is last few weeks. And the picture is, I think the picture on the weeklies is more clear. Looks as if we're seeing the start of some changing of directions of the tails. But if you look at the dailies, then they're quite erratic. The high yield one is probably very clear. That's a very nice rotation towards leading. So that could be an interesting asset class to keep an eye on. But if you look at, for example, corporate bonds, then you can see that, and this is, by the way, until last Friday, then you see that that all of a sudden moved the other way, which is a sort of an irregular move. You see government bonds kind of hooking to the left, which is uncommon, quite strong movement all of a sudden in a negative direction again. They moved quite positively and now they start moving negatively again, and that's sort of what we see here on the weekly tail for Gov. The US dollar is making a kind of a similar move, and the longer term you see that the tail is rolling over inside leading, so the dollar strength is still there. I had expected this daily tail to actually continue back to leading and push that weekly tail back up again. Looks as if we need a little bit more time there. All in all, the bigger picture, as I read it from here, and again, the rotations they seem to be in a transition period, and it's not really very clear yet which way we are going. Let me watch a few of their individual charts together with you, so maybe we can get a handle on that. And the first one that I want to bring up is the euro-dollar chart, the weekly one. We've been talking about the euro-dollar and the strength of the US dollar for quite some time already, and the recent break below that support level around 103, 103.50 was very important, and what we expected happened. We got an acceleration lower, and euro-dollar actually hit parity and slightly lower. Parity means that $1 US is €1. For the time being, that parity level, that one level, seems to have acted as support, and we can see that better when we look at the daily chart. You see that we have that spike low here, was just below 1, and we started moving slightly higher now. We're now back above 1 again, and for the time being, there is a good chance that we will see a rally in euro-dollar. But be very aware of the long-term picture. And I brought up this chart a few times in the past few weeks already, but I think it's very important because look at how important that support level was. 103, maybe even 104 is a crucial level, or was a crucial level for euro-dollar. So from the current 1009 level, we could go back to 103 and it still wouldn't negate this downward break. So I believe that the US dollar will remain very, very strong versus the euro, but also versus the other currencies. If we look at the S&P 500, the downtrend's still there. We bounced from 360 upward, put in a new lower high around 393, and today the market just closed, and as you can see we had quite a good opening, but then we closed lower again, so we didn't even reach that 390 level, let alone the 393 area. It is, for now, I think the S&P is in a sideways move. 393 is a resistance area. If we can take that out, we can see potentially move the S&P towards 410, 415, don't know. But I think that the ease of movement for the market is still to the downside. The risks, in my opinion, are still very much to the downside. And if this is the low, if this is really the low for this, for ending this market that went from 476 all the way down, then I believe that we will, I don't think we will see a move all the way up without looking back. I think that if this is really the low, we will see some sort of a bottoming formation coming out, and there will be time to get back into the market with less risk, because I think that's the crucial part of my narrative at the moment, that there is still a significant amount of risk in the stock market at the moment in the S&P 500. If you look at government bonds, this is GOV, this is the aggregate, still pushing against its old support level, now acting as resistance. And by the way, the yield curve is now really inverted. 10 minus 2 is minus 20 bips, so that's an inverted yield curve, 20 bips inverted. That's quite a significant number. I haven't seen that for a while. If you look at IEF, which is the 7 to 10 year bonds, then you can see that they are resting at an important support level. They have bounced up. That means that there is a good chance that we will see a little bit higher bond prices and therefore lower bond yields in that longer segment. And then we move to both commodities that we started the whole show with, or at least the asset class rotation, and you see that the sharp move lower is still there. I think there is, without hurting the uptrend, that is very much intact. There is still quite some room for commodities, in this case is DJP, to move to potentially levels around 30, 31. And if you look at GSG, quite similar image, touched on resistance, reversed, and we could go to levels around 20. The worst case scenario, maybe even 18.5, without negating this long-term turnaround in both price and relative strength as we have seen it. Finishing off with the chart of stocks versus bonds. This is SPY versus IEF. I believe that we are resting at an important support level. That 3.6 ratio for SPY versus IEF I think is quite important. If we break lower, I think that already the preference is still for bonds, because we are in a series of lower highs, lower lows. We are resting around 3.6. If we break that lower, we will very likely get an acceleration lower, which means an acceleration in the preference for bonds over stocks. What's happening in sectors? On the right hand side we have the RRG for daily data, and on the left hand side we have the weekly RRG. If we look at last week, then it was pretty clear, that week was pretty clearly in favor of offensive and growth stocks. And that's best visualized by the strong tails for XLY and XLK, which are both moving through the center of the chart from lagging into leading. And pretty much the same goes for XLK. So you got XLY, consumer discretionary, and technology, both making a rapid move from lagging into the leading quadrant at a nice RRG heading. So that's a positive move, it's a positive tail for both of these sectors. On the opposite side, we see that whole complex of defensive sectors, of which we've been saying they've been leading the moves. That's why the market is still playing defense, and that's why there is still downside risk. All of those sectors, especially healthcare, staples, utilities, and to a lesser extent real estate, are now moving from leading through weakening, and they are at a negative RRG heading, so can't rule out that they'll be hitting the lagging quadrant anytime soon. If we move to the weekly RRG, then we can see that that energy rotation is still ongoing. So you see that big massive move for energy, which is still in terms of RS ratio the strongest sector. And what you can see on the daily is that the daily tail for XLE is already picking up relative momentum. Not so much relative strength yet, but relative momentum definitely. And as soon as that tail hits improving and starts to move to the right, i.e. picking up relative strength, that could be the signal for the weekly tail on XLE to actually start curling back up and potentially move back into the leading quadrant. We'll have a look at the price chart in a minute. I'm going to switch this one off here to better get a view on what's going on in the other sectors. I'm going to do the same here because XLE now moved far to the left on this one, so it's really the sector that's making the big moves. If we look at this, then we can see that those rotations into offense, into growth names like technology, discretionary, to a lesser degree communication services, is already translating into weekly tails that are starting to move slowly higher on the RS ratio scale as well. And here also we see that especially utilities and staples are losing relative momentum. They are still high on the RS ratio scale, so there are definitely still strong sectors in terms of relative strength. And healthcare is the only sector inside the leading quadrant on the weekly scale. So for the time being, it looks as if we have a move back into offensive / growth stocks, and that defensive sectors are not negative yet, but they are continuing to lose relative strength and relative momentum. And it's a time now that we need to monitor closely whether this is a temporary move within the longer term picture, and these tails will curl back up and they will pull these ones back up to leading, and we will remain with a market that is driven by defense. Or is this the first signal of an early signal of a turnaround back to more growth orientated and offensive stocks, and maybe, as we discussed when we talked about asset classes, an early sign that the low in the S&P 500 is in. I'm not confused yet, but I'm keeping an open mind to pick up what the charts are telling us. Let me quickly walk you through a few of those sectors of which I think that they are showing interesting or important charts. So here is energy, and as I said, the tail here is, I ticked it off, but it's inside weakening, as you saw a minute ago, and you can see that the relative line is still moving higher. The RS ratio is coming from a very high level, and the price chart is touching on old resistance, which we can now expect to move to function as support. So as long as that 65 area remains intact and we put in a new low there, I think there is a very good chance that XLE will start to turn back up and become one of the leading sectors again. If we move to financials, that sector is right there inside lagging, and it's resting at a support area. And in order, from a positive point of view, financials need to remain above, let's say, $30 US. That will also very likely keep that relative strength line above its support level. We go to technology. That looks a lot like the chart of the S&P 500. Here's the tail moving higher, and the reason for that is that relative strength has started to move sideways over the last few months, and that's why those RRG lines are picking up. What we do need in order for this to actually continue its outperformance is a break of relative strength out of that range to the upside, and I think the only catalyst for that would be an upward break for XLK, for the price of XLK above 135, breaking this downtrend and starting to move higher. Staples is moving sideways, putting in a lower high. Look at the relative strength, that's still at very high levels. The RS momentum line is starting to push RS ratio lower. It's still a very high reading on the RS ratio scale. But again, we need to keep an open mind on what's potentially coming towards us. Real estate is still working its way lower. There's no doubt that that is a very weak sector. We have been working our way lower from that head and shoulders reversal pattern. If we break below this support in relative strength, we will very likely see an acceleration lower. For the time being, we're holding up, and XLRE is kind of at the 100 level in terms of RS ratio. Utilities still holding up above rising support. Relative strength still moving higher but losing momentum. That's what we see on those tails. A defensive sector still above that support. That's good, but we have to wait and see whether this loss of relative strength is temporary or it will pull that sector lower at a negative heading and potentially back towards the lagging quadrant. Too early to tell at the moment. Healthcare, the only sector inside the leading quadrant, still holding up very well above that horizontal support level. The relative strength is still holding up well. That's the only defensive sector that is still very, very strong. So in terms of defense, healthcare is actually the strongest sector at the moment. And then look at discretionary. We are resting at support. The relative strength line is slowly turning around. That is what's causing that up move in both RRG lines, and that's what's pulling that tail upward. Again, it could be the early warning sign of a change in trend of the bigger picture, but it's too early to tell at the moment. I would quickly like to touch on the growth value rotation. For quite a while, the value stocks were in favor over growth. That was pretty clear. But since a few weeks, you see that that preference for value has rolled over and growth curled up on the other side. And those tails are now they're always moving in opposite directions, but it looks as if growth is picking up. Now, value is still on the right-hand side, which means that it's a relative uptrend. Growth is still on the left-hand side, which means that it is a relative downtrend versus the Dow Jones US index. That's the entire market. But I think we need to address it because this is suggesting that growth is picking up. And if you look at the weekly, and we just saw the daily rotations, or the sector daily rotations in favor of some of the growth sectors. And we can see that coming back on the RRG as well. For a while you saw that growth lost again, and that was fitting with the improvement of value. So value was starting to pick up in line with value on the weekly being on the right hand side and potentially curling back up. But over the last few days, I have to say, the rotation rapidly reversed. So this is now 1, 2, 3, 4, 5, 4. So 4 days ago, you saw that the rotation rapidly reversed back in favor of growth. And that suggests that we're back in line with the tails on the weekly, which are also starting to favor growth. The only thing that still worries me, or at least I'm keeping an eye on it, is the long-term rotation between growth and value. Because what you see here on the RRG is basically the RRG representation of the growth value rotation as you see it here in a one-on-one comparison. And what I see here is a massive top formation at the end of a long uptrend. And this very clearly tells us that growth is out of favor and value is in. The only thing that we're currently seeing is a bounce, is an upward bounce. I think this is a massive double top, and I've got the annotated chart here. This is the weekly version. You see that it is a massive top formation that's completed. We had the initial decline, and the rally now, I mean, of course, there is no certainty, but very, very likely that will stall at that breakout level. This is a textbook double top formation. So the only thing is that because this is a ratio, these distances can have quite an impact on price and relative for those individual indexes. That gives us a situation that we're now looking for a period where we can see growth stocks, growth sectors improving for the next couple of weeks, maybe even. This is a weekly chart, so this can easily take a couple of weeks before it hits that level. And that's fine. And it corresponds with the growth stocks on the sectors actually improving. But we got to be aware of this long-term chart and this long-term turnaround and not get overly enthusiastic. So for the time being, I think that this rally of growth stocks is a recovery after completing that massive top formation. Okay, so the bad news is that I ran out of time. I don't have enough time to talk you through extensively the differences between the sector rotation model and seasonality, as I explained at the start that I would try to do that. The good news is that there is an article for you. So in the RRG blog published today, there's an article that deals with the differences between the sector rotation model, sector rotation versus seasonality, how I approach it, how I use it, and how I try to connect theory versus practice. If you're interested, please go to the RRG blog and read that article. And that wraps it up. This was Sector Spotlight for this week. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Looking forward to see you again at a new episode of Sector Spotlight next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.